Today we're going to look at the company Grupo Aeroportuario del Centro Norte, headquartered in Mexico and traded on Nasdaq Stock Exchange under the ticker OMAB. Please stay tuned for the important disclosure information at the conclusion of this video. Grupo Aeroportuario del Centro Norte was established in November 1998 as part of the Mexican government's strategic initiative to privatize the country's airport infrastructure. Formed from state-owned assets, the company initially focused on defining its operational structure before a significant shift in 2000, when the government sold a 15% stake to a strategic management partner. This transition marked the beginning of a multi-year modernization program that included the expansion of major terminals, such as Terminal A in Monterrey, and the introduction of specialized cargo operations. The company entered a new era on November 29, 2006, when it completed its initial public offering, listing simultaneously on the Mexican Stock Exchange and the Nasdaq. This full privatization provided the capital necessary for large-scale infrastructure projects, most notably the 2010 opening of Monterrey's Terminal B. Over the next decade, OMAB diversified its business model by expanding into non-aeronautical services, including the development of an aero-industrial park and the opening of on-site hotels under the Hilton and NH Collection brands. A major change in OMAB's corporate governance occurred in late 2022 and early 2023 when the global infrastructure leader Vinci Airports acquired a 30% stake in the company, becoming its largest shareholder. This partnership has aligned OMAB with a worldwide network focused on digital transformation and environmental sustainability, as evidenced by the company's recent issuance of pioneering sustainability-linked bonds in 2023. Today, OMAB operates 13 international airports, serving as a critical engine for connectivity and economic growth across central and northern Mexico. The business model of Grupo Aeroportuario del Centro Norte is built upon a high-margin concession framework that leverages a regional monopoly over 13 international airports in central and northern Mexico. The company operates through two primary business divisions: aeronautical, non-aeronautical. The aeronautical segment is the core revenue driver, derived from regulated passenger charges and aircraft landing fees. This segment is highly resilient due to the captive nature of its users and is directly tied to the robust passenger traffic in industrial hubs like Monterrey, which accounts for roughly half of the group's total traffic. The non-aeronautical division represents OMAB's strategy to monetize every passenger beyond the flight itself. Commercial activities include high-traffic retail leasing, parking, and premium VIP lounges, while the diversification arm manages unique industrial and hospitality assets, such as on-site hotels under the Hilton and NH Collection brands. OMAB's customer base is strategically split between domestic and international markets, with domestic travelers representing approximately 83% of traffic. Its primary customers are major airlines, including low-cost carriers like Volaris and Viva Aerobus, alongside legacy carriers such as Aeromexico. Internationally, OMAB captures vital business and leisure flows from the United States and Canada, served by global airlines like American, United, and Delta. This international segment is particularly valuable as it aligns with Mexico's nearshoring trend, where global manufacturing companies increasingly utilize OMAB's northern airports as critical logistics and corporate gateways to North American markets. The financial journey of this airport group reflects the broader transformation of the Mexican aviation industry from a state-managed utility to a sophisticated, diversified commercial enterprise. At the core of the business model is a revenue structure that has matured in both complexity and resilience. In the early years following the initial public offering, the company relied almost exclusively on regulated aeronautical services. These fees, which include passenger charges and aircraft landing costs, formed a stable but singular foundation for growth. This period was characterized by steady, incremental gains tied directly to the expansion of domestic flight routes and the emerging presence of low-cost carriers that began to redefine the regional travel landscape. As the company entered its second decade as a public entity, a strategic shift toward non-aeronautical diversification began to fundamentally alter its margin profile. This transition was driven by a realization that every passenger passing through a terminal represents a retail and service opportunity. Investment flowed into the modernization of commercial spaces, leading to a vibrant ecosystem of duty-free shops, restaurants, and premium passenger lounges. This segment proved to be a powerful growth engine, often outperforming traffic growth as the company refined its ability to increase the average spend per passenger. The development of high-end airport hotels and specialized cargo logistics facilities further insulated the group from the inherent volatility of the airline industry. The most dramatic chapters in the company's recent history were written during the global health crisis and the subsequent industrial recovery. While a temporary and unprecedented contraction in travel forced a lean operational reset, the rebound was bolstered by a significant macroeconomic shift. The rise of industrial activity in northern Mexico, often referred to as nearshoring, transformed the group's flagship hubs into vital gateways for international corporate travel. This led to a period of record-breaking financial performance, where aeronautical fees reached new heights due to both increased volume and periodic tariff adjustments approved by the government. The financial architecture of the group has undergone a profound transformation since its initial listing, transitioning from a government-integrated utility into one of the most efficient airport operators globally. This evolution is clearly visible when examining the relationship between top-line expansion and the generation of liquid capital. In the early years of the public era, the company operated with a relatively modest cost structure, where the primary outflows were tied strictly to the maintenance of existing infrastructure and basic administrative overhead. During this period, the conversion of income into operating cash flow was highly predictable, as the aviation market in central and northern Mexico was still finding its footing in the privatized landscape. As the company matured, the complexity of its operational expenses grew, driven by a dual commitment to modernization and diversification. The cost of services, which includes the labor and utilities required to keep 13 international hubs operational, expanded as terminal capacities were increased. Simultaneously, investment in human capital and corporate governance led to a steady rise in general and administrative spending. Unlike technology firms, the group does not dedicate capital to traditional research and development. This specialized focus ensures that the group remains at the cutting edge of logistics and passenger experience without the risk profile typically associated with laboratory-based R&D. Income tax obligations have naturally scaled alongside its record-breaking profitability, particularly as the group began to post world-class margins. This explains why the operating cash flow often remains exceptionally healthy even during years of high accounting expense, as these internal mechanisms reflect the long-term utility of the physical assets rather than immediate cash outflows. Capital expenditure has historically followed a cyclical pattern, dictated by 5-year regulatory agreements with the Mexican government. These periods of heavy investment, characterized by the construction of new terminals or the expansion of runways, are the primary factor influencing free cash flow volatility. Despite these multi-billion peso commitments to the physical future of the airports, the group has consistently demonstrated an ability to generate surplus capital. This financial strength has allowed for a generous and sustainable return policy for shareholders. Notably, the group's reliance on traditional salary-based compensation rather than dilutive stock-based programs has ensured that the capital generated remains directly attributable to the equity holders, maintaining a clean and transparent path from the runway to the balance sheet. The financial management of this airport group over the last 2 decades tells a story of disciplined growth, transitioning from a conservative, debt-free posture to a highly sophisticated and leveraged capital structure designed to maximize shareholder returns. In the years following its initial public offering, the company focused primarily on organic stability, maintaining a robust cash position relative to its minimal external obligations. During this early phase, capital allocation was largely internalized, with the surplus generated from the central and northern regional hubs being used to fortify the balance sheet rather than being aggressively returned to the markets. This cautious approach provided a necessary buffer as the group navigated the early complexities of operating as a private entity under a long-term government concession. As the operational model matured and passenger traffic proved its long-term resilience, the group's philosophy toward capital distribution underwent a fundamental shift. The introduction and subsequent growth of regular and special dividends became the primary vehicle for delivering value to equity holders. This transition was marked by a clear commitment to returning nearly all excess cash flow not required for mandatory infrastructure maintenance. Even in years of significant capital expenditure, the company demonstrated a remarkable ability to sustain its payout policy, often augmenting ordinary distributions with one-time strategic dividends when the balance sheet allowed. This practice has established the group as a premier yield play within the Latin American transportation sector, attracting a diverse base of global institutional investors. The company's approach to share repurchases has historically been opportunistic rather than programmatic. While maintaining a reserve for buybacks, management has generally prioritized direct cash distributions over stock-based returns. This strategy ensures that the benefits of ownership are realized immediately by shareholders while avoiding the complexities of long-term dilutive compensation schemes. The group's reliance on traditional cash-based incentives rather than extensive stock-based compensation is a hallmark of its transparent governance model, ensuring that the free cash flow remains cleanly attributable to the capital providers. Strategic acquisitions have remained rare, as the group's primary mandate is the stewardship of its existing 13-airport portfolio, though it remains alert to opportunities that align with its core logistics and commercial expertise. On the liability side of the ledger, the group has evolved into a sophisticated user of the debt markets to optimize its cost of capital. The gradual increase in interest-bearing debt reflects a strategic move to lever the group's highly predictable and regulated cash flows. By issuing local and international bonds, the group has successfully funded its ambitious master development plans while maintaining credit metrics that remain the envy of the industry. This leverage is carefully managed, with a focus on long-term fixed-rate financing that protects the business from sudden shifts in the interest rate environment. Today, the group's balance sheet represents a fine-tuned balance between maintaining high liquidity for operational flexibility and employing debt strategically to fuel the infrastructure required for Mexico's burgeoning industrial growth. The leadership and ownership of Grupo Aeroportuario del Centro Norte have been characterized by a blend of long-term institutional stability and strategic international partnerships. Since November 2018, the company has been led by Ricardo Duenas. Before joining OMA, Duenas served as the chief financial officer of Grupo Aeroportuario de la Ciudad de Mexico, where he managed significant financing for large-scale airport projects. Under his guidance, OMAB has navigated a period of intense growth and modernization, particularly as northern Mexico continues to benefit from industrial expansion. The ownership structure of OMAB is defined by a significant strategic partnership with Vinci Airports, which became the company's largest shareholder in late 2022 and early 2023 with a 30% stake. The remaining ownership is well diversified. Institutional investors hold approximately 36% of shares, while public and retail investors account for roughly 34%. Individual insider ownership is minimal, representing less than 0.1% of the outstanding shares. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. In the bull case scenario, the industrial explosion in northern Mexico, specifically the Monterrey hub, exceeds even the most optimistic forecasts. OMAB becomes the primary beneficiary of a total global supply chain realignment. Catalysts include the full operational success of massive industrial projects like Tesla's Gigafactory, which drives double-digit increases in high-margin business and international cargo traffic. Revenue growth is further accelerated by maximum tariff increases due to aggressive infrastructure expansion. Management maintains its extremely efficient cash-to-yield model, aggressively increasing dividends and stock repurchases. Strategic acquisitions might involve a major international expansion into other high-growth Latin American aviation markets. Base case scenario assumes a continuation of the current healthy growth trajectory, with OMAB operating like a highly profitable regulated utility. Growth is driven by steady domestic demand and a gradual increase in international routes to destinations like Madrid, Paris, and Seoul. While the company remains a dividend powerhouse with consistent annualized growth, it remains focused on its existing 13 airport portfolio rather than risky acquisitions. Operating margins remain stable as management successfully navigates occasional one-off maintenance and security cost spikes. The bear case is defined by macroeconomic fragility rather than immediate collapse. In this scenario, persistent geopolitical tensions or a significant U.S. recession dampen the nearshoring trend, leading to a plateau in industrial corporate travel. Catalysts include unfavorable changes in the Mexican government's regulatory framework, such as an increase in concession taxes or a cap on airport usage fees that limits pricing power. A persistently strong Mexican peso could continue to pressure international revenues, while rising security and maintenance labor costs eat into operating margins. In the bull case scenario, we assume the following: revenue growth at 12%, operating cash flow margin at 60%, capex growth at 8%, stock-based comp growth at 0%, dividends growth at 14.5%, stock repurchase growth at 12%, acquisition spending in the next 20 years at 15 billion peso, stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $170 worth of value per share in 20 years, $336 in 30 years, and $601 in 40 years. In the base case scenario, we assume the following: revenue growth at 8%, operating cash flow margin at 51%, capex growth at 6%, stock-based comp growth at 0%, dividends growth at 8.6%, stock repurchase growth at 3%, acquisition spending in the next 20 years at 5 billion peso, stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $92 worth of value per share in 20 years, $132 in 30 years, and $168 in 40 years. In the bear case scenario, we assume the following: revenue growth at 4%, operating cash flow margin at 41%, capex growth at 3%, stock-based comp growth at 0%, dividends growth at 3.3%, stock repurchase growth at 1%, acquisition spending in the next 20 years at 0 billion peso, stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $58 worth of value per share in 20 years, $69 in 30 years, and $76 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.